In this video, we will discuss the process of turning non-qualified funds into qualified funds. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently a retirement strategist and portfolio analyst for FEFA in St. Louis, Missouri, and an adjunct professor of accounting and financial management for the University of Maryland Global Campus. The objective of using qualified funds, IRAs, 401ks, 403bs, etc., is to manage the tax rate at which you have to pay income. So if you are young and still want to put money into one of these accounts and are in a relatively low income tax bracket, you might want to choose a Roth IRA and lock in a low bracket. If you are making a good income and expect to retire at a lower tax bracket, you might want to use a regular IRA or 403b when you are in one of these higher tax brackets, and then you are retired. You can either bring out the money, pay taxes on it, and spend it, or do a Roth conversion, and again, try and manage your money so that you're not paying a high tax, but instead paying at a low tax rate. There are a large variety of tax-deferred accounts. We list the more common ones here: the IRA, the individual retirement account, the federal government's thrift savings plan, a 403b, which you would have if you work for a non-for-profit institution or state institution, a 401k, which you might have if you work for a for-profit institution, and a 457b, which is sort of a supplement to either the 401k or the 403b that allows you to put away twice the amount of money. If you are working for a government institution, there isn't a lot of difference. If you are working for a for-profit institution, the money in this account is subject to the credit risk of the organization you work for. So if in the chance that your company goes bankrupt, you might lose this money. IRAs are rather limited. If you're under age 50, they only allow you to put away $6,000 per year, tax deferred, $7,000 if you're over 50. The other accounts currently allow $19,500, and the TSP, 403b, and 401k allow a catch-up provision if you are 50 or older, up to $26,000. One possibility to give individuals more control over their own retirement would be to expand the dollar amounts for IRAs that anyone can control, and this would give them more control over their money versus the accounts that are linked to the government or their other private sector employer. There are, of course, many restrictions on how IRAs may be contributed to, as well as 401ks and 403bs. All of these contributions must generally come from earned income. For a 401k or a 403b, your employer would be doing that directly, so it's not an issue. For an IRA, you must make sure that you have enough of your own money to contribute from earned income, not from income, for example, off an investment appreciation. There are some exceptions to this rule. If you're a non-working spouse, you can have what's called a spousal IRA, as long as your spouse earns enough money to cover both your and the couple's contributions. Contribution limits do not apply, of course, to transfers from other retirement accounts, such as those to use to create a rollover IRA during retirement when you are trying to use the accounts again to lower your tax brackets. If you do contribute to an IRA, it's important to make sure on the account that your contribution goes to the right year. Typically, contributions have to be made before April 15th. Sometimes if you make a contribution at the beginning of the year between January and April, it can be confused as to what year the contribution goes to, and therefore what year you will get the tax deduction. There are IRA income limits based on how much income you have if you are working for an employer for which you are contributing to their 401k or 403b. For a single and head of household in 2020, there are no limits for 65,000 or less, and then there's a gradual phase out for 65,000 to 75,000 income per year, and you may not contribute to an IRA if you make more than 75,000. The other limits are shown here for married filing jointly. For married filing separately, as always, there are a lot of penalties, and in this case, you're not allowed to contribute if you make more than 10,000. The government does generally not favor married filing separately tax returns. For Roth IRAs, there are income contribution limits regardless of whether or not you are in an employer's 403b. For high income people making more than 139,000, you cannot generally contribute to a Roth, but these limits do not apply if you are doing a Roth conversion. And as noted earlier, well, the limits are somewhat generous for married filing jointly, going up to 206,000 before phase out, and up to 139,000 before no contributions are allowed for single. For married filing separately, the limit is only 10,000 and very restrictive. Another very useful account to not only defer taxes but completely eliminate taxation is the health savings account. If your employer provides a high deductible healthcare plan, then you as an individual in 2020 can contribute up to $3,550, or a family $7,100. If you're over 55, you can add an extra $1,000 contribution. You get to deduct this income from your income bracket, and if during your life it is spent on healthcare expenses, you never have to pay taxes on it. The minimum deductibles for accounts to be compatible with an HSA are $1,400 for self-only and $2,800 for family. They also have to have maximum out-of-pocket amounts for self-only of $6,900, for family of $13,800. If your employer allows you to participate in one of these, for most people, particularly if you are young and healthy, this is a far better way of financing your healthcare expenditures than regular health insurance. It allows you as an individual to shop around to find, for example, the pharmacy that has the lowest cost drugs, to find the doctor that might charge you the least amount, and it allows you to save for the future. If you don't have health expenditures this year, the health savings account will be useful to you for the rest of your life. It is important to distinguish the HSA, the health savings account, from the FSA, the flexible savings account. With a health savings account, you get to keep your contributions for the rest of your life. For the FSA, the flexible savings account, you must spend most of that money in the year which you get the tax write-off. So the HSA is far, far better than the FSA. Beyond the accounts we discussed, the IRA, the 401k, and the 403b, which are applicable to individuals and individuals working for large corporations, there are also other less frequently used accounts that apply to businesses with a small number of employees. One of these is the Simplified Employee Pension, or the SEP IRA, which can be set up with a business with fewer than 100 employees. Only employers, including the self-employed, can contribute to the SEP, so the individual does not have the opportunity to match any of these funds if they work for a small business. It has the advantage from the employer's point of view that it allows the employer to adjust how much money is contributed each year depending on the profitability of the company. Therefore, it is more flexible than the next account we will discuss, which is the Simple IRA. In 2020, employers can contribute up to $57,000 or 25% of an employee's compensation, whichever is less. So the dollar amounts contributed are more generous than a 401k or a 403b, but it is more controlled by the employer and not as much by the employee. Another type of small business account, as mentioned, is the simple IRA. Both this and the SEP are easier to set up than a 401k, have less administrative expenses, therefore they are quite appealing to small employers. The employer may match up to 3% of the employee's annual contribution for the simple account, or they can set up a non-elective 2% contribution of each employee's salary without requiring employee contributions. In 2020, the contribution limit to employees was $13,500, lower than a 401k. Employees 50 years and older can make up an extra $3,000 contribution as a catch-up contribution. There are, of course, specific withdrawal rules that apply to IRAs, 401ks, 403bs, and other retirement accounts. Most of these are based on your age. For example, if you try to withdraw money from your IRA before age 59 and a half, you must pay not only taxes on that money at whatever your current tax bracket is, but also a 10% penalty. There are exceptions to this rule, which include first-time home purchases, qualified higher education expenses, substantially equal payments scheduled so that they pay out through your entire life. Well, you can start these before 59 and a half. After age 59 and a half, you can alter them and then make payments however you want to. Some medical and disability payments, and some distributions for reservists called to active duty. So generally, there are penalties before withdrawing your money before age 59 and a half. There are also penalties if you withdraw your money too late. Currently, you are required to start minimum distributions by age 72, up from age previously 70 and a half, and these rules are not applicable to year 2020. If an RMD is not made before the applicable deadline, December 31st of the tax year, the account owner is subject to a 50% excess accumulation penalty tax on the amount not taken. After age 72, you are required to make minimum distributions from your retirement accounts or experience substantial tax penalties. For 2020 again, these RMDs are not required, but they will be required again in 2021. This table shows how they were calculated when the requirement age started at 70 and a half. The IRS has not yet released new tables. How you would calculate that RMD is by taking your total amount in retirement accounts, say $1 million, and at age 70 and a half, divide that by 27.4. That amount must be withdrawn from your accounts and taxes must be paid on it for a given tax year, and the withdrawal must be made by December 31st. Note, as you grow older, the percentage of your account that has to be withdrawn increases drastically. At age 80, you would divide by 18.7, and if you are lucky to live to 115, over half of the remaining money in your account must be withdrawn. This increasing requirement in removing money from the account is one of the reasons it is advantageous for many taxpayers to start doing Roth conversions at an early age, so this required minimum distribution table does not push them as they grow older into higher and higher tax brackets. So Roth accounts, unlike IRAs, 403bs, and 401ks, are not tax-deferred accounts. With a IRA, a regular IRA, you put the money aside today, you write it off on your taxes, and then you have to pay taxes at a later date. With a Roth IRA, you put the money in the account now, and then you never have to pay taxes, capital gains, dividends, anything on it again in the future. The contribution limits on a Roth IRA are very similar to regular IRAs. For the IRA, it could be $6,000 or $7,000 if you're over 50, And there are also Roth 401ks and 403bs with the same limits as a regular 401k or a 403b, 19,500 or 26,000 if you are over 50. Roth conversions are a two-step process, sometimes referred to as a backdoor strategy. You cannot directly convert to a Roth from a 401k, 403b, or the federal government's thrift savings plan, but after you leave your employer, you can move that money to a traditional IRA, and then that traditional IRA may be moved to a Roth IRA. At the time it is converted to a Roth IRA, the income must be reported on IRS Form 8606. It is a very common strategy as soon as you leave employment to estimate what your tax bracket will be for the rest of your life and start converting up to the top of that tax bracket to avoid RMDs pushing you into an even higher tax bracket in the future. Another way of managing your retirement, if you are not extremely attached to where you've been working, is to retire in a tax-friendly state. There are several states that have no income tax at all: Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. There are other taxes shown, such as Alabama, where pensions are tax-free. That also includes Hawaii. And there are some other taxes or other locations that are in a transition of being completely tax-free states, such as New Hampshire and Tennessee, which at this point tax some dividends and some related investment income. If you would like to learn more about how to minimize taxes on your qualified funds, your IRA, 401k, 403b, TSP, or other retirement accounts during your retirement years, contact your FEFA representatives. You can contact us at www.fefa.org, info@fefa.org, or me, Kirby Cundiff, specifically at kcundiff@fefa.org. If you would like to know more about how to manage your retirement taxes, you can again go to fefa.org, or aarp.org, or investopia.com, or the irs.gov site, or the federal government's tsp.gov site, or my personal YouTube channel. Again, search for Kirby Cundiff under YouTube. I thank you for watching this video.